So, Namaskar and welcome everyone to this session on financial management. This is a demo I'm doing for CA Intermediate. My name is CA Amit Arora. Let me share screen. Let's begin the session with thought for the day. Your real exam is held when you are preparing for the exam. What you write in the exam is just delivering the result. So as we attend this course on financial management, in every session, we'll begin with a thought for the day. So students, I hope that you realize that your real exam is when you're preparing for the exam. So enjoy these classes. And once you enjoy, then only it's learning. If it is joyful, then only it's learning. So not only one should be present digitally, it is essential we also follow certain digital rules. Be a good listener. So many students are attending the session. When I explain a concept, it is my request that we all are good listeners. So some of the rules we'll follow. Everybody will be on mute other than the speaker. Then unmute please before speaking. So at all point of time, it's essential that only one person unmutes and speaks. This way, we'll have a good audio quality. As we progress, I will certainly request for volunteers among the students for reading, writing, leadership. It will be an interactive session. Let's respect time. Let's start on time. Let's conclude on time. So let me give you in this session an overview of the course. Why do we study financial management? It's very essential for finance professionals and for professionals as such. The objective, of course, is maximization of shareholders' wealth. Now, with that objective in mind, financial management primarily is a function of three major components. So we are going to study investment decisions, financing decisions, and dividend decisions. Whatever we study during this course, it is all about two things: sources of finance and its effective utilization. That is what the broader parameter is. So what could be the source of finance? You can get money from your family, from your friends. You can put your own capital, equity, which is the shareholders' money, which is the owner's money, right? Or you could get debt. So you borrow from banks, financial institutions. That is where we will study the cost of capital. How much does it cost me? Where do I invest? How I do the budgeting part? What will be the returns? So it's a very exciting subject where we will learn all these aspects one by one. Now, broadly to give you an idea, investment decisions will include portfolio decision making. And the moment you talk about any investments, it is about a balance between return and risk. Now, let me ask you, higher the return, higher the risk. So the decision we are going to make is a trade-off between these two parameters. Investments could be long-term or short-term. The long-term are usually for maybe 2 years, 3 years, 5 years, very important decisions. They are known as capital budgeting decisions, which is about investments in fixed assets. And the short-term ones, usually less than a year, they are about investments in current assets. Financing decision deals with mode of financing. What is the best mix of equity capital or debt capital? And dividend decisions is about retained earnings versus the earnings will distribute, which is known as the dividend. Now, let's look at the working capital. Now, remember investment decisions, we said that investments could be for current assets. So the investments for current assets basically depend upon operating cycle. See this picture. For a manufacturing firm, how does an operating cycle look like? You procure raw materials, convert them into work in progress, they become finished goods. And once you sell them, you have receivables, say debtors. And then when that receivables converts into cash is where I can say my operational cycle is complete. That's why whatever we call as current assets usually are the assets which are consumed within the operational cycle. And we say it's like within 1 year. So when I budget for it, that is called as working capital budget. We're going to study that in detail. It's going to be really joyful knowing about working capital budget, because we all know budget is a very important financial tool for any business organization for a defined period of time. Now imagine if I don't have money for my operating cycle, how will I ensure that finished goods are produced? How will I ensure by the time receivables get converted into cash, I have liquidity for my firm? So do you understand how important decisions does a financial manager take? So on one hand, while the working capital budget decisions are very important, the other aspect is capital budgeting. Now, if I ask you what is 2 plus 2, what will you say? The picture says 5. Now, it may be intriguing to many, but when we will learn the concepts of NPV, net present value, which is a capital budgeting tool, when we'll study about another concept, which is called time value of money, maybe you will agree with me then that 2 plus 2 could actually be 5. Let's give an example. If I give you 1 lakh rupees today, or I say I will give you 1 lakh rupees after 2 years, which one is better? Today, because there is time value of money. If I get, say, 1 lakh rupees today, then over the course of those 2 years, I could invest that money, I could get some return, and therefore there is time value of money. So when we are going to look at the capital budgeting aspect in greater detail, the concept of time value of money and calculating the NPV becomes very critical. As the name suggests, it's the net present value, which means it's the difference between the present value of cash inflows and the present value of cash outflows over a period of time. Very simple calculations that we'll study, a lot of numericals we'll do. And once you calculate, the decision making will be dependent upon this matrix. So if the present value of cash inflow is greater than the present value of cash outflow, the green color indicates that the NPV is positive, project acceptable. Similarly, there's a break-even point where present value of cash inflow is equal to the present value of cash outflow, NPV is 0. The finance manager could still consider the project as acceptable. But when the NPV is negative, the third scenario, where the present value of cash inflow is less than the present value of cash outflow, then the project is not acceptable. So whether I have a decision making of buy or sell, invest in project A or B, how do I ensure liquidity to meet my obligations of current assets, or whether I look from capital budgeting perspective or solvency perspective to meet my long-term obligations. These are some of the decisions that the finance manager will take. So to quickly recap, the objective of financial management, the subject we're going to study, is how do we maximize shareholders' wealth? Primarily 3 key decisions: investments, financing, dividend. And they're all interrelated. Say, for example, company makes investments to earn better and give better dividends to equity shareholders. In order to make investments, company needs finance. And one of the long-term sources of finance is retained earnings. If a company retains more, it'll give out lesser dividends. So do you see how investment, financing, and dividend decisions are interrelated? So I'm sure as we study this course of financial management, it will be joyful and something that perhaps will give us dividends all our life. Thank you very much.